Hello, welcome back, guys. One of our subscribers at some point asked me to make a video to explain what the danger of adjusted earnings is. And I have briefly touched based on that in the video that I made about DocuSign, but this has been maybe a couple of months ago, but many people may not have watched that video. And so I'm making a dedicated video, a dedicated one, to explain what's exactly going on with these adjusted earnings and why we should be super careful about this. Now, if you're new around here, remember to leave a thumbs up on this video, that helps a ton, and also subscribe. We'd like to have you around for a lot of different videos about investing, a topic that I really enjoy talking about, and I have a lot of videos around here. So, DocuSign. As you'll see here, I'm on DocuSign's official website over here, and I'm looking at their press releases. This was June 9, 2022. It was the latest earnings report that ended in fiscal year April 30, 2022. And I also have the CNBC one, which, as you'll see over here, it is also the earnings report for the company for the same quarter, pretty much for the quarter ended April 30, that's 2022. So let's compare the two a little bit. You will see here that the total revenue of the company was 588 million over here. And if you take a look at CNBC, you will basically see the same thing, $588 million. Okay, that's good enough till here. And the other thing we can see here is our tool. I will use our tool here, for which if you don't have access, of course, Patreons have access. You can become a Patreon and get full access. You will see Q1 2023 here, 588.7 million. So everything is perfect here. It may be a little bit round up or in this case, but that's for visual purposes. But it's basically the same thing. Now, if you take a look again at the DocuSign press release, you will see that the company's GAAP gross margin was 78% and non-GAAP gross margin was 81%. So why two different things, and what is the difference between these? Now, GAAP, when we're talking about GAAP means generally acceptable accounting principles. So it's basically a format that has specifications. It's a standard that specifies accounting principles that companies need to be following for their report. Otherwise, everybody would do their own thing, and we don't really want that. We need to have some sort of an acceptable standard here. And you will see that their GAAP net loss per basic and diluted share, that's the earnings per share, pretty much it's the GAAP earnings per share, was 0.14 cents. So they lost 14 cents on 200 million shares over here. But if you go to CNBC over here, you will see that the earnings was a 38 cents per share adjusted over here, and that's key, versus 46 cents per share as expected by analysts. So while the report over here, the DocuSign report, is talking about a loss, CNBC is talking about a gain. So what's the difference here? Is it a mistake? It's not really a mistake, but it's a sort of manipulation thing that happens a lot with companies, sometimes for good reasons, sometimes for sort of like bad reasons. Now, what is going on here? Now, if you take a look at our tool over here, you will see our net income. And our net income over here is negative. So the company is actually losing money. That's the right one. It's the one that they basically mentioned here, the fact that they are losing money. Now the thing is, when you are examining net income is derived after all these expenses over here. So it's depreciation, amortization is added back, interest expenses added back. So all of these things, income tax expenses, are all accounted for expenses. And so you derive a final, pretty much a bottom line net income here, and you get the EPS from that. And you will see that the EPS actually indeed for Q1 2023 is a loss of 14 cents, is what exactly the company mentioned over here. So what is going on again? Why CNBC is actually posting a 38 cents per share win over here instead of a loss? Now, our tool over here also supplies the earnings transcripts, and I went back to Q1 year 2023. And as you will see here, during this call, we will present GAAP and non-GAAP financial measures. And so non-GAAP financial measures exclude items, as you'll see, which means that they exclude expenses. They exclude stock-based compensation expenses, employer payroll tax on employee stock transactions, amortization of acquired intangible assets, amortization of debt discount and issuance cost from our notes, acquisition-related expenses, fair value adjustments to strategic investments, impairment of lease-related assets, and, as applicable, other special items. In addition, we provide non-GAAP weighted average share count and information regarding free cash flow and billings. So as you can understand, this is an adjustment that the company generates, and they can do that. It's a non-GAAP adjustment that the company generates pretty much to give you sort of like an operational EPS is what, or a core EPS sometimes it's referred to, is the EPS excluding some of these items. But the thing is, do you really want to exclude all these items from your pretty much analysis? I would say not. Now, in some situations, there are some items, like, for example, some unexpected taxation, like some tax reforms, for example, as have happened in the past with companies, where it does make sense to be examining the non-GAAP structure, pretty much, because otherwise you may get a false sense of, of losing money, for example. But over here, the company is actually excluding a lot of items, including stock-based compensation expenses, which, as you can understand, are salaries. They are just not given as cash. They are given as pretty much shares, or stock. But this is actually an expense for the company. It is a very, very actual expense that you incur as a stockholder. And so, as you can understand over here, you get a sense of positivity, and this is what is reported over here, a sense of positivity just because of these adjustments, pretty much excluding all these items. And there is a very, very well-known metric for which I have made separate videos and discussed quite significantly in the past. And you will see it over here, and I have made this tool in order to reflect all this action over here. It's basically sort of like a stream of content over here, where if you understand the basics, you can really read what is going on here with the company. So as you'll see here, again, we're looking at Q1 2023. The company has 588 million in terms of its revenue, and then they had a gross profit of 456 million. The gross profit is derived after excluding the cost to generate this revenue. For example, the cost of materials could be some cost of that sort, or basically transferring the product to a specific warehouse, for example. Now, after this gross profit, we have more expenses. We're not done, right? We have general and admin expenses over here. We have selling and marketing expenses. We have total selling, general and admin expenses, which is a combination of those. And if you exclude this item over here, you basically go down, and you get to our operating income. And of course, there are other expenses, in the way. And then we are arriving at our operating income, which is negative over here. And then we have even more expenses, right? Because as you can understand, we have interest expenses, for example. We have, for instance, some depreciation, amortization, and all these things add up and create even more and more expenses. And if you go down and all these expenses are added together, again, you can kind of do these calculations even manually if you wanted to, and you will reach to this outcome, the $27.37 million. Now, companies tend to use a metric that is called EBITDA, and sometimes when they are very negative, when they're losing a ton of money, or at least some money, they tend to use this EBITDA because sometimes it is positive, at times it's positive. Because what is EBITDA? So EBITDA means earnings before interest, taxes, this is the abbreviation, depreciation and amortization, so it excludes these expenses. As you'll see over here, again, this is set up in a way so that you can actually pretty much see exactly what is going on. Here are the actual items that are getting excluded. So if you go from net income, 27 million, and start adding this back over here, you will get to the EBITDA, which is minus 2 million. So you will get from minus 27 million. If you exclude the earnings before taxes, for example, you get to EBITDA over here. And so you have a sense now of what is being extracted in order to go to a more positive number and go to EBITDA, which is also still, as you'll see here, still negative, which probably calls for some more non-GAAP adjustments in order to make it look more positive. What would be that? What would that be? Well, how about removing some of the cash-based stock-based compensation that the company had for the year? It was 286 million. So you can exclude these items as well and make it look even better. In fact, that's exactly what the company is doing, right? Remember, we saw it here. They exclude stock-based compensation expenses among other items over here. So this is why you should be super, super careful, and it makes a lot of sense to be examining the actual press release over here. But again, when you are looking at a tool, like for example our tool over here, will instantly tell you that the net income is actually negative. Again, if you take a look at the income statement over here, you will see it immediately that the company has been losing money. That's annually. And if you take a look at the quarterly periods, again is what we examined Q1 2023, the company had a loss of 14 cents a share and not a gain, as CNBC actually reported over here, which again, it's not a mistake, it's correct, but it's adjusted. And that's exactly what adjusted means. And as you can understand, there are some cases again when we do potentially want to get some adjustments, and they do make sense. As I mentioned earlier, a tax reform could be one because it can severely affect our outcome and actually dilute our opinion of a company for the fact that they actually had a one-time expense. But the thing is, if they do it every quarter, for example, and if they exclude items for which it doesn't really make sense to exclude, as stock-based compensation doesn't, it's an expense. It's salaries, pretty much. It's just not paid in cash. Then you get a very, very skewed metric here. And if you just look at this one, you may be thinking, okay, this company is starting to generate some money here. Maybe I'm buying this one. But again, if you try to do something of that sort, our tool here will warn you. And also, if you go by our stock evaluator over here, things will be even worse for a potential buy, because you will instantly see that the company has been having net income margins that are negative. You will see it in this very handy table here. And now you know that this is losing money. And you can actually see it even here in the averages. So you instantly know, regardless of what the company is actually telling you in terms of their non-GAAP assessment, you see with your own eyes over here that the company is losing money, and you take your own way, your own decision based on that, and not what CNBC, for instance, is telling you here. Hope that was helpful. Hope that helped a little bit. If it did, please leave a like, and I'll see you in the next video. Bye-bye.